Hello, everyone. Thank you for joining us today. My name is Jason Nord, and I'm the Director of the TIF Division at the Office of the State Auditor. Haley Rowan, who is our TIF Administrator, will also be presenting, and Lisa McGuire, who's one of our auditors, will also be monitoring questions. All right. Earlier this week, we hosted an introduction to TIF, which was meant to be a foundation to this and future training. If you missed it, it was recorded and it'll be available on our website in a few days. If you're new to the TIF world, I'd highly recommend you check that out. And it might also be a good refresher, even if you are not new. We're going to kick things off here by getting to know who's in attendance a little better. We've sprinkled in a few of these poll questions throughout the presentation. There we go. Just let us know how long you've been working with TIF. Close the poll and show it. Okay, it looks like kind of an even split between those that have been around a long time and those that are pretty new. So we kind of run the gamut here. And so for those of you that have worked with TIF a long time, this might largely be a review. Hopefully you'll learn a few things. Or if you're new to TIF, this might feel a little overwhelming and a lot to take in. And just know that that's actually pretty normal. Sometimes you have to see this stuff a few times before it all really starts to sink in and make sense. So, all right, with that, let's take a look here. In this session, we're going to cover three topics. I'll be covering what's new in TIF in terms of legislative updates from the last couple of sessions, and I'll also provide an overview of the laws and limitations that are outlined in the TIF Act. And then Haley's going to go over some of the expectations for TIF administration, including reporting requirements, documentation, and tips for staying in compliance. So what's new in terms of TIF changes in the law? The 2021 legislature made the following changes to the TIF Act. First, there's a new temporary authority to transfer unobligated tax increments. The transfers must be used to assist private development, to construct or substantially rehabilitate buildings and ancillary facilities, if doing so would create or retain jobs in the state. So it's similar to the jobs provision from back during the Great Recession, for those of you that might remember that. The authority to make transfers expires at the end of this year, at the end of 2022 actually, but those transferred amounts can be spent through 2025. And written spending plans are required, and there are approvals that are required and various parameters and limitations that apply. So if that's something that seems interesting to you, check out our statement of position on our website on temporary TIF transfer authority. And if you want more information, you may have also seen, if you've started working on your TIF annual reporting forms for 2021, that there's a new section added to the transfers tab that facilitates this provision. And Haley's going to show you that when we get to her part. If you have used this authority and you haven't already done so, make sure you send us a copy of your spending plan as soon as possible. So second, there was a TIF Act provision that there is in the TIF statute a provision that allows an authority to elect to increase pooling by 10% for a district in order to assist affordable housing. And what the 2021 legislation did is they expanded this to allow that pooling to be used for owner-occupied housing that meets the income limits for housing districts in the TIF Act, whereas prior to this change, it was limited to additional pooling to assist low-income rental housing that met some federal Internal Revenue Code qualifications. The next two items here are related. The 5-year rule was extended to be an 8-year period for redevelopments that were certified after 2017 and before June 30th of 2020. This came about from concerns about the pandemic possibly affecting development activity and slowing things down. And so then the last item is a corresponding extension to the 6-year rule. So the 6-year rule becomes a 9-year rule, essentially, if the 5-year rule was extended to 8. For 2022, the tax bill stalled out, so there were no changes enacted, but there had been significant changes in the tax bill that our office had actually proposed. We had been having conversations with stakeholders for some time about a variety of difficulties with the TIF law. And prior to the legislative session, we put together a group called the TIF Oversight and Administration Discussion Group, where we had county, cities, school representatives, people from revenue, House and Senate staff, and some TIF practitioners. get together to give us feedback on some proposals we had to address those problems. And while that group didn't like formally vote or sign off on the proposals, we did work our way through a variety of issues and got to a point where I think we mitigated any concerns and garnered support for those proposals. So we're hoping that that'll get enacted next year. And since it didn't get enacted this year, I'm not going to go into great detail, but I'll just kind of give you a quick preview of what might be coming next year. The changes were in 3 areas: pooling, admin expenses, and the TIF violations statute. Our goal was to mitigate some of the ambiguities and improve the ability of authorities to understand and comply with the TIF Act, and improve our ability to provide oversight. And that required more than just some mere technical changes. And in particular, with the pooling laws, we addressed the 6-year rule primarily, and eliminating the extra annual pooling restriction and recrafting the whole 6-year rule to make it easier to understand and oversee. The provisions related to administrative expenses include an expansion of the definition and a little bit of an easing of the admin limit for certain expenses. And then the violation statute changes were more technical clarifications in that part. So again, those didn't pass this year, but keep a lookout next year, as those could be pretty significant changes. All right, now let's take a look at the wide range of TIF laws and limitations that an authority needs to be aware of. I thought I'd start out with an overview of the creation process for a TIF district. And I'm only going to go over this really briefly because we're actually working on a separate training video about the TIF district creation process, because that's probably something you're going to need when you need it. And so we'll have a video out there available for that we hope to release next month. We also are hoping to release a more condensed video that would be for city councils and other TIF authority decision makers, like maybe a 20-minute video or so to kind of cover the essentials of what they should be thinking about or could be thinking about when considering the use of TIF. So the process of creating a TIF district starts with drafting a TIF plan. There are many requirements regarding a TIF plan, but those will be covered in that other training. And you can also find a statement of position on our website about TIF plans. That plan must then be given to the county and the school district to give them an opportunity to provide comments and feedback. And that has to occur at least 30 days prior to a public hearing, which must be held after a public notice where the public can provide any comments and feedback. And after that hearing, the municipality may approve the TIF plan, and then to complete the process, a request for certification of the district has to be provided to the county auditor, who then sets the original values and gets it all set up in the tax system. And copies of the plan have to be submitted to both the Department of Revenue and to our office, along with a plan submission form that we'll mention again later. So just to expand a bit on the approval, if the TIF authority is an HRA, an EDA, or a port authority, the plan must be approved by the municipality itself in addition to the entity. So the plan may be approved only after a public hearing and published notice in a newspaper of general circulation in the municipality at least once in the period of 10 to 30 days prior to the hearing. And that published notice has to include a map of both the district and the project areas. All right, and to expand a little bit on the notification and feedback from counties and schools, the TIF plan must be provided to the county auditor and the school board clerk, along with an authority's estimate of the fiscal and economic implications of the proposed district. So that fiscal and economic implications of the district includes an estimate of the tax increment that'll be generated over the life of the district, along with the shares that are attributable to the county and school levies, a description of the probable impact on city provided services, including public infrastructure and the ability to issue debt, as might be affected by the issuance of any general obligation TIF bonds, and any information requested by the county or the school district. They can do that either by a written policy, or they might just ad hoc ask you for more information regarding the size, timing, or type of development. So for housing and redevelopment districts, an authority also has to give a separate 30-day notice and an offer to meet with the county commissioner who represents the area in which the TIF district will be located. It's kind of a double requirement there then. And although a municipality isn't bound by most feedback, a municipality must comply with one possible demand. A county can require that certain road costs be included in the TIF plan and be paid from tax increments. They have a 45-day period to assert that option. And by the way, that could cause a timing issue. So you only have to give them 30 days notice before you approve the plan. But if they take the 45 days and then tell you that they want these costs included, then you'd have to kind of redo the hearing and everything and redo the notice to get the plan changed. So it might be it might be wise to give them a 45-day notice so that you wouldn't have to redo that if that's something that comes up. And speaking of county requirements, although this is not part of the comment and feedback process, be aware that a county can bill a TIF authority for their administrative costs for setting up the district and the property tax system and doing all the calculations and taking actions that they need to take and making the distributions and all that. So just be aware that some increment may need to be used to pay those county administrative costs. All right, next I'd like to highlight some important dates that are key for both identifying districts and determining how certain provisions and limitations in the TIF Act apply. The approval date, which is when the municipality approved the district as opposed to the HRE, EDA, or Port Authority, is the benchmark date for provisions that allow an election to delay the first increment and for which building permits must be shared related to a prior planned improvement provision. And both of those will be discussed more in that TIF district creation video. It's also at one point helped determine some duration limits, but I think that was a while ago, and I don't know that any of those districts are still active. The certification request date is the date that the authority makes the request to the county auditor to certify the district. And a person might not think that that would be an important date to track, but it actually is. It determines relative to a June 30th cutoff date, which year's value is going to be the original base year. And it also is the most common date referenced for law changes. So for example, when a new law is passed, it might say that the new law applies to districts with a request for certification on or after such and such a date. And it's also the timing date for a few other provisions that we're not going to detail, but the point is the date that you make that request is an important date to record. And the certification date then is the date that the county actually certifies the original value. And it similarly serves as the benchmark for several TIF provisions like the 4-year rule, the 5-year rule, the 6-year rule, and several other provisions, many of which we'll talk about later. The date that the first receipt of increment occurs, and note that that's the actual date of first receipt and not just what is anticipated, but that actual first receipt date determines the required decertification date under maximum statutory duration limits. So that's an important timing. And then the required decertification date is something that should be tracked. It's the date that a district would be required to terminate. It might be the statutory maximum duration, or if earlier maximum deadline was written into the TIF plan, as sometimes the city might choose a shorter duration limit so they can get the value on the tax rolls faster. But understand that the required decertification date might be preempted by a requirement to decertify early under the 6-year rule. We'll talk about that more later. So this maximum date should still be tracked, but early decertification might be required. All right, next let's look at a couple of important definitions in the TIF Act, starting with the definition of tax increment. In our intro to TIF webinar from Monday, we noted that tax increment is the property tax paid on captured value, and this might include TIF share of any property tax credit reimbursements. But there are other related revenues that are also defined as tax increment. So sales and lease proceeds are also defined as tax increment to the extent the property was purchased with TIF. Interest and investment earnings on balances of tax increment are defined as TIF. Any principal or interest received from loans or advances of tax increment dollars also retain their tax increment status, and similarly, repayments of tax increment dollars pursuant to agreements also retain their tax increment status. I believe these definitions were meant for the sake of all taxing entities to ensure that tax increment dollars would not convert to unrestricted revenues. So you couldn't just buy and sell a piece of property and then be left with sale proceeds that are no longer tax increment. So instead they are defined as tax increment. It's also required and fundamentally important that tax increment revenues be segregated from other funds. This is kind of one of the most important things to make sure you stay in compliance with the TIF Act. And there are a couple footnotes here on this slide that I should call out. TIF calculations can produce something called excess taxes or excess TIF. So when you get a settlement distribution report or dollars from the county, you might see an item labeled excess TIF or excess taxes. That isn't tax increment. And without getting too sidetracked, tax increments cannot be generated by increasing tax rates. It can only be generated by increases in value. So when taxes are generated by multiplying the increased tax rate by captured value, those are just extra revenues that are created and they're not specified as being tax increments. So, so just note that excess TIF is not tax increment, and try not to get it confused with excess increment. They didn't vary the terminology very well, but excess increment is a different animal. It's when you get more increment than what you're authorized to spend. And the second note here is that many of the limits, like the admin limit and admin expense limit and the pooling limits, are a percentage of tax increment, and it's just the percentage of taxes paid on captured value and not these other revenues that are defined as tax increment. So that's a detail to pay attention to when you're addressing those limits. It's just on the main increments, not on the other defined increments. All right, another definition in the TIF Act that's noteworthy is the term bonds. The TIF Act defined bonds to include other obligations beyond what you might normally think of as being a bond. So it includes refunding bonds, but also pay-as-you-go notes and interfund loans and other similar obligations. So if you see restrictions in the TIF Act regarding bonds, be aware that it might not just be it's not just referring to what you commonly think of as a bond, but it also includes pay-go notes and interfund loans and those things. So for example, in the TIF plan, you're required to provide an estimate of bonded indebtedness. So that estimate should include pay-go notes and interfund loans and such. All right, now turning to the limitations in the TIF Act, the most basic rule regarding tax increment is that it must be used in accordance with the TIF plan to pay bonds and to achieve the purposes of the underlying development acts that authorize the projects and the use of TIF. Increment for a district cannot be used for unrelated activities. As I mentioned in discussing important dates, there are maximum statutory duration limits on the number of years tax increment collection can be collected, and it varies by type of district. So redevelopment and housing districts can collect 26 years of increment. Economic development districts can collect 9, and renewal and renovation at 16, and it's 21 for soils condition districts. An authority, again, may specify a shorter maximum duration limit in the TIF plan, or just choose to decertify early and get the value on the tax rolls. And again, early decertification might end up being required by the 6-year rule, but these are at least the maximum durations. The use of tax increments to pay administrative expenses is limited by the TIF Act to 10% of the lesser of either the total estimated TIF expenditures that are authorized in the TIF plan or the total tax increments collected from taxes paid on captured value. And the measure is slightly different for older TIF districts, but this is the limit for newer TIF districts. And compliance with this limit is evaluated at the end of the life of a district. And be aware that it's common that admin expenses often occur early in the life of a district. And so early on, you might be exceeding the 10%, and that's fine. It just must be within the limit by the end of the life of the district. But sometimes when a development fails to get off the ground, you can end up with a bit of a violation where the limit is exceeded. So for example, say you had $10,000 of initial admin costs, but you're expecting millions of dollars in development, but the district ends up falling through and you only end up collecting a couple $1,000s of increment before it's decertified. Well, the amount that exceeded the 10% of that actual couple thousand of what was collected becomes a violation then. And so that is remedied by repaying the excess admin expenses. And generally, whenever expenditure violations are made, the way to remedy it is to pay back to the county auditor the amount of the excess expenditures, and then those get redistributed to the county, city, and school district. It's also important to recognize that administrative expenses must be actually incurred and documented. The 10% is not just a retainage. It actually has to be actual documented costs. All right, when a TIF district receives more increment than is needed to pay the current costs that are authorized in the TIF plan that are not paid by other sources, the excess increments must be returned to the county auditor and get redistributed to the county, city, and school district, or they can be used to prepay outstanding bonds. The existence of excess increments for a year must be determined annually and based on the current TIF plan that's in effect at the end of the year. Our reporting forms facilitate this determination on a separate tab. So you see the excess increment calculation tab or the EIC tab in your reporting forms. And sometimes you might notice that that tab will say that the calculation is not required. It's kind of built into the statute that if the increment collected so far is not even close to the limit, then it isn't required to be determined yet. But when there is excess increment determined, you need to return or use the excess to prepay debt by September 30th of each year. And this is actually a common problem that we address where excess increments are not returned in a timely manner. So make sure you're checking your reports that are due soon here, and make sure to act by the end of September if there are excess increments to either return that or prepaid debt. All right, well, before I move on into pooling limits, I want to stop and see if there are any questions.
We do have a question regarding the administrative expenses. Okay. The question is that their understanding is that the tax increment can be used to pay for consultants and auditors, legal fees, that kind of thing as admin costs. But they're wondering if they can use tax increment to pay for staff time.
Yeah, that's a good question. Yes, they can. You can use tax increments to pay for your own staff administrative time in doing things like filling out reporting forms or whatever administrative duties you have related to your TIF districts. But just be aware that you should carefully document, how you're doing that, how many hours were spent doing what and at what rate. Because if we end up asking for the justification for the admin expenses that are being claimed, there needs to be some documentation of how that was determined. So it's not just kind of fill in an amount situation, but yes. All right, any other questions before I move on to pooling?
It looks like that's it for, oh wait. Someone just sent in a question asking to clarify excess TIF on property taxes that's not TIF revenue.
Yeah, so I know that's kind of a complicated thing, but so when a value goes up in a TIF district over the base value, that generates increments. But if your original tax rate, say the city tax rate when you created the TIF district was 40%, and later the tax rate for the city went up to 41%, and you multiply your tax rate by the captured value, but that extra 1%, because the tax rate went up, that gets applied to the captured value, that is not tax increment. Only the tax increment is limited to what the original tax rate was. So if you do end up generating extra taxes because the tax rate went up, they call that excess taxes or excess TIF, And that's just extra revenue. So it's not tax increment, doesn't need to be tracked and reported as excess increment. It's just excess taxes that you're available to use for lawful purposes. So, all right, why don't I continue here with pooling. So one of the most significant topics in TIF is pooling. And pooling is a term that refers to the use of increment outside the boundaries of the TIF district, but within the larger project area. Administrative costs don't really have a location, so to speak. So the statute defines those as being out district pooling expenditures. And so any administrative costs that you're incurring have to fit within your pooling limit. For redevelopment districts, the law requires that at least 75% of increment must be used within the TIF district. And so up to 25% may be pooled and spent elsewhere in the project area. All the other TIF types of TIF districts have a pooling limit of 20%, so 80% has to be spent in. Although for housing districts, pooling is not really an issue because you can only use housing districts for housing projects, and housing projects are generally defined as being in district wherever they're located. So pooling is kind of a non-issue for housing districts. And the overall pooling limit is evaluated at the end of the life of the district. So again, early on, pooling might be higher or lower, but you have to meet it in the end. There's a provision that we noted earlier when we were talking about the 2021 legislative changes that allows pooling an extra 10% if it's being used for certain affordable housing. Sometimes we also call that the 2D pooling because the provision for that is located in a subdivision 2 paragraph D. This option must be elected in a TIF plan, so it has to be kind of preconceived and added to the TIF plan. Although pooling normally occurs outside the district and in the project area, these housing expenditures can be for activities that are outside the project area. And they're permitted notwithstanding the normal district type limitations that we'll talk about a little later. And the housing that may be assisted must meet certain federal requirements of the Internal Revenue Code, or now that we have the 2021 legislative change, it's also okay to use those for owner-occupied housing that meets the income limits that are in the TIF Act. And if all of a district's pooling, other than admin costs, is for these qualifying housing purposes, then including the regular 20 or 25% that's allowed, then the TIF Act has a provision that allows the admin costs to be treated as if they're in district. So it basically allows the authority to really maximize the 30-35% that can be pooled for affordable housing. One critical provision to understand is the 5-year rule. So in addition to the core locational aspect of pooling, the 5-year rule provision adds a timing element as to what gets considered in district or versus out district. And so increment that is spent on activities in the district are only considered to be in district expenditures when they're spent within the first 5 years, or if they're being used to repay bonds and obligations that finance costs that were incurred in those first 5 years, or they're spent for certain housing purposes. So therefore, new uses after the first 5 years, after certification, are considered out-district pooling expenditures, even if they are for activities that are physically located in the district. And the intention behind this timing parameter is to prevent expanding the scope of expenditures beyond the originally planned activities. One of the concerns early on in the history of TIF was that TIF districts were just being held open for their maximum duration, and they were being amended frequently to fund new activities beyond the scope of why the district was initially created. And so now you can still kind of expand your goals, but those expansions have to fit within your pooling limit. So let's look at an example here to help just kind of illustrate it. Here, the project area is the larger area in blue, outlined in blue, and the TIF district is the smaller area outlined in gold. Say in year 1, a bond is issued that finances the acquisition and demolition of 2 parcels and some right-of-way. This is in-district activity. In year 2, there's a second bond issued that finances some related utility and street work. And which expands both in and outside the district. The portion that's located in the district is in district activity, but the portion that's located outside the TIF district is out-district pooling. And then in year 7, the authority decides, well, we need a new traffic signal here. And because of the 5-year rule, this will be an out-district pooling expenditure, even though it's located right in the middle of the TIF district because of that timing element. So just to drive this concept home, let's launch another poll question. And open here. All right. If a new bond is issued in year 8 for new costs inside the district, are they considered in-district costs or out-district costs? All right. It looks like the vast majority, you got that right. It's out-district costs. Again, not because of the locational aspect, but because of the timing aspect. Any new costs that are incurred after those first 5 years are out-district. Unless, I guess, you fell into that 8-year extension that was just passed, then they might be in district. So, all right, the 6-year rule then follows up on the 5-year rule, and it provides an additional annual pooling limit that begins in the sixth year, while also creating an early decertification requirement. The 6-year rule essentially provides that starting in year 6, or the year after that 5-year rule period ends, the in-district percentage of increments each year must be used for in-district purposes and are not eligible for pooling, even if it might fit within the overall pooling limit over the life of the district. And we'll look at an example of this in a moment. But maybe more importantly, the 6-year rule contains the early decertification requirement, where a district must be decertified when outstanding bonds have been defeased and when sufficient money has been set aside to pay the remaining in-district obligations. So in other words, you can't stay open and continue to collect increments solely to fund out-district pooling activities, and needs to be decertified once kind of the in-district obligations are paid. So, and the purpose of this then is to help get that captured tax base back on the tax rolls as soon as possible. All right, let's look at an example of the 6-year rule's additional pooling limit by looking at that example we were previously talking about the year 7 traffic signal. Let's say that through year 6, the district had received $480,000 of increment, and as of the end of year 6, $420,000 had been spent in district. Only $10,000 had been pooled so far for admin costs, and so there's a cash balance of $50,000. Then in year 7, they get another $80,000 of increment. And so the in-district share of that is going to be restricted, because remember, it's an each year requirement. So $60,000 of that $80,000 is restricted for only in-district obligations, and $20,000 of that $80,000 can be pooled. So if the new traffic signal, say, cost $100,000, that would fit within the overall pooling limit, because 25% of the $580,000 received when you include the year 7 increment is $140,000, and so far only $10,000 had been pooled. So spending the $100,000 on the traffic signal would bring total pooling to $110,000, and that's within the overall limit. So that's good. But the problem is spending $100,000 in year 7 would use up the $50,000 balance that's on hand, and it would use up the $20,000 of newly received poolable increments, and it would require you to use $30,000 of that in-district share of year 7 increment in order to pay it off. So that would not be allowed, and that would end up being a violation. So this is something that requires careful attention by authorities, and it's something that I think people have had a hard time understanding and keeping good track of. So the potential good news here is that this might be eliminated if the provisions that were in the tax bill this year get passed, but that hasn't happened yet. So, and if that law does pass, there would be a bunch of clarifications of how the 6-year rule works. So stay tuned, check back again next year and see if we get some of those clarifications or not. Okay, early decertification is actually very common. Based on decertifications that occurred from 2016 to 2020, 70% of redevelopment districts decertified early, as did 78% of housing districts. And not just early by like a year or two, but on average by 10 years. Even economic development districts with shorter durations still decertified early 37% of the time. So that may be the 6-year rule at work, but it also may be just authorities making decisions to get TIF districts wrapped up and get the value back on the tax rolls. So now moving on from pooling, but one other time-based provision that's in the TIF Act is the 4-year knockdown rule. This provision seeks to limit districts to the parcels on which development activity is actually occurring. So if no activity commences on a parcel that's in a TIF district in accordance with the TIF plan after 4 years from the date of certification of the original value, then that parcel must be knocked down such that it no longer captures value and no longer produces tax increment. Activity in this context means things like demolition, rehab, rehabilitation, renovation, and site preparation. Activity includes qualified adjacent street improvements like a new street or relocated streets or rebuilt streets, but not just like main routine overlays or maintenance. And activity excludes in this instance the utility services like just extending sewer and water. So if development activity subsequently commences on a parcel, it can be restored to the TIF district and again start producing tax increment, but its original value will be reset to that most recent value rather than the one back when the TIF district was created. So authorities have a responsibility to report this activity to the county auditor, and it's the county auditor who actually oversees this provision and enforces it. So make sure you are communicating that, and Haley will tell you more about when that should be done. Okay, tax increment cannot be used for general government purposes, such as avoiding levy limits or financing government buildings. It cannot be used for common areas as a public park or for social, recreational, and conference facilities, although parking structures or private conference facilities may qualify. A TIF district cannot include parcels that recently benefited from various property tax programs that protect land from development, such as green acres, open space, rural preserves, or metro ag preserves. It would be counterintuitive to use a subsidy to aid development after you've used subsidies to protect against development. But there is an exception to this limit for housing districts and for qualified manufacturing distribution facilities. TIF Act has a section that addresses bonds, and interfund loans in particular are subject to some restrictions. An interfund loan must be authorized by resolution, and the terms of the loan must be documented in writing. There are maximum interest rates that apply to interfund loans, and such loans must be properly reported in the annual reporting to our office. So it's not sufficient to simply regard some early expenditures as being reimbursable loans. If you haven't formally, created written terms and if you haven't been reporting those, then they wouldn't qualify as an interfund loan. So, all right, how are we doing on questions? Do we have any more questions?
We did have a question about the 4-year rule. You had mentioned that the authorities have to report to the counties the qualifying activity, and someone wants to know if there is a specific form or format that activity needs to be reported to the county.
Yeah, there's nothing specific that it's expressed in statute or that our office has identified, or I don't think revenue either. So it'd probably be more up to the county as to what they consider sufficient. I think the statute might just talk about notifying them by a certain date, and Haley will cover the timing element of that. But so I guess there's not any specific form that I know of, but maybe you'd want to check in with your county to see what's sufficient to them. And maybe some counties do have something specific they want. I'm not really sure, but there's nothing from us or nothing that I'm aware of as far as a format. All right, any other questions?
It looks like that's it for right now.
All right, let's continue then. So we'll talk here about some different district type limitations. So in addition to each of these district types has a variety of requirements that define, how you can create them. And those are going to be covered in our how to create a TIF district video. These requirements are just more of the ongoing requirements that apply to each district. So for redevelopment districts and renewal and renovation districts, know that 90% of the increment from these types of districts have to be used to correct blight conditions that allow the creation of the district. And for soils condition districts, increment may only be used for acquisition, remediation, and administrative costs, including the cost to prepare a development action response plan that gets approved by the PCA. So be aware of how you're spending increments from those district types. And for economic development districts, increment may not assist a development if more than 15% of the buildings and facilities measured by square footage are for purposes other than those that are listed here. So these space and use limitations do require attention. Generally, commercial or retail developments are not permitted. However, there is a small city exception that allows a small city, which is defined as one that has a population of 5,000 or less and is located 10 plus miles from a city of 10,000 or more. And that's by straight line, not by driving distance. To assist a commercial facility, you can assist a commercial facility of up to 15,000 square feet. But be aware that if you are using the small city exception, the increment from those districts can only assist those in-district costs for that facility and pay admin costs. You cannot do any other pooling or finance any other expenditures if you're using that small city exception. So that's an ongoing issue to be aware of. An increment in a housing district must solely be used to finance the cost of housing projects and directly related public improvements and administrative expenses. No more than 20% of the square footage of buildings that receive assistance can consist of commercial, retail, or other non-residential uses. And in order to qualify as a housing district, certain income requirements must be met. So for an owner-occupied housing, only the initial purchaser and occupant have to qualify for the under the income limits. But for rental housing, that income limit requirement is an ongoing one that requires attention. And you can refer to statute and the Internal Revenue Code for the exact specifics. But generally for owner-occupied housing, the limit is that 95% of the units must be within 115% of the greater of either the area or state median income. And for rental housing, there's like a two-part test where either 20% of the units have to be occupied by those that are 50% or less of the area median income, or 40% of the units must be at 60% or less of the area median income. And there are some alternate income limits that can be substituted if the project is part of the MHFA Challenge program. Authorities must be able to document compliance. And although we don't really lay out exactly what kind of documentation has to be used or anything like that, possible documentation might include, for owner-occupied housing, tax returns, W-2s, pay stubs, mortgage loan applications, or employer verifications. And then for rental housing, there are MHFA forms that might be helpful, or the IRS form 8703, or really any other documentation or spreadsheets that can demonstrate and track the verification of incomes. Decertification. By statutory definition, to decertify or decertification means the termination of a TIF district, which occurs when the county auditor removes all remaining parcels from a district. And doing so then ends the collection of tax increment, or turns off the spigot, so to speak. So in some respects, at that point, the TIF district would be done. However, TIF restrictions on tax increment might not be done, and a TIF district remains active in the sense that it has to continue to report and follow the TIF Act until all remaining tax increment revenues are spent or returned to the county auditor. And a large number of districts that report each year are decertified districts. So things really aren't done until the books are closed, so to speak. So if you do have a decertified district, you may want to get that increment, either lawfully use that increment or get it returned. You'll be done with that TIF district. Statute provides that a county auditor must decertify a TIF district upon the earliest of reaching the maximum statutory duration limit, reaching an earlier duration limit if one is specified in the TIF plan, completion of the actions required under the 6-year rule, which means having paid or set aside sufficient increment to pay all the in-district obligations, or upon receiving a written request by the authority to decertify the district. And in that case, it is decertified either upon the date that is specified in the request or upon receipt of the request if it doesn't have a specified date. Generally, decertifications are often specified as being December 31st, as we'll address in a moment. And note that a county is not going to be aware of the 6-year rule activities. So an authority is responsible to notify counties that decertification is required when the 6-year rule applies. And continuing to receive increment after decertification was required is a violation that does need to be remedied. So if you didn't shut down when the 6-year rule said you should have shut down, you would need to return increment that is received after that point. When looking at the statutory maximum duration limit, be sure to distinguish from the anticipated required decertification date from when you created the district versus the actual limit that's based on when first receipt of increment actually occurred. We've seen first receipt of increment occur both earlier than and later than what's expected. So be sure to revisit tracking your required decertification date once that first receipt of increment actually occurs, because that's the real driver of the limit. And then increments from taxes payable in a year that after a TIF district terminates, getting ahead of myself. Increments from taxes payable in the year that a TIF district terminates are paid to an authority. And so even if you close the district in, say, September, you're going to get your full year's increment. And so that's why oftentimes the decertification date just gets expressed as December 31st, because an earlier date might not be of particularly meaningful. What I was starting to say is delinquent taxes that are received after decertification, so a county gets some delinquent taxes paid to them for a decertified district, those are not to be distributed to the TIF authority anymore. And there's only one exception, which is if the non-payment in a timely manner of those delinquent taxes had caused an obligation to go unpaid or to be paid from other sources. In those cases, an authority could communicate with the county auditor and provide the information that's needed. And in those cases only would the county auditor then be able to distribute delinquent tax increments to the authority to help make up for those issues. Well, let's launch another poll. All right, which of the following rules may require a TIF district to decertify? The 4-year rule, 5-year rule, 6-year rule, or all of the above? Let's see what we got. All of the above. That's a tempting answer whenever there's an all of above, but the correct answer is the 6-year rule. So the 4-year rule requires removal of parcels from a TIF district, but that doesn't necessarily decertify or shut down the district because those parcels can be added back later if activity resumes. So the 4-year rule isn't really requiring decertification, and the 5-year rule is just setting the timing parameter of what is in district and what is out district, and it's really the 6-year rule that contains that early decertification requirement. So good. All right, well, let us continue here. There's more that we aren't covering in this webinar because we can't cover everything, although I think we hit the major stuff. And because of this, and because requirements vary over time, obtaining legal and professional advice from knowledgeable advisors is a good idea when making use of TIF. And so with that background, I'm going to turn it over to Haley to discuss tips and other topics related to annual ongoing administration of TIF districts.
All right, thanks, Jason, and hello, everybody. So in this section, we're going to talk about some of the record keeping and the reporting requirements that are necessary to the administration of a TIF district. First, we've provided a few resources as handouts to this webinar, and you can find them in the handouts pane, or you can get it from the reminder email that was sent out. So one of the handouts is a sample checklist of administrative tasks and checks that should be helpful when reviewing information of a TIF district. This includes annually required tasks, recommended checks, and conditional items, and we'll be talking about a lot of them in this section. Additionally, we've also provided a list of useful hyperlinks to help navigate to the OSA website and a couple of external sources. Okay, so first and foremost, and Jason talked about this earlier too, the proper segregation of funds and strong record keeping are critical for TIF compliance. The TIF Act requires tax increments received for any district have to be segregated into a special account or accounts. They cannot be deposited into the general fund or commingled with other funds. There's no specific method required, but separate funds, detailed accounting codes, spreadsheets, and other files must be applied in a manner sufficient to effectively track and report those tax increment funds. While all expenditures and obligations must be documented, there are 3 notes, particularly worth highlighting. All administrative costs must be documented. And as Jason mentioned, the 10% limit doesn't permit a general retainage. The amounts have to be for actual costs. Developer expenses must be documented prior to reimbursement as part of a pay-as-you-go agreement. And those terms have to be documented in writing. These cannot simply use tax increments to reimburse early expenditures without a formally established interfund loan. So records must be retained in accordance with a formal retention schedule. The General Record Retention Schedule for Minnesota Cities provides that creation documents for a TIF district have to be retained for 10 years beyond the duration of the TIF district. So for a housing or development district that lasts for the full duration, that could mean that you need to store those documents for 36 years or more. Detailed financial records must be kept for 10 years or 6 if certain criteria are met. So you'll need to track and monitor progress with respect to the various limits and restrictions. We recommend you do this at least annually, but if you can do it more frequently, that's better. This is where the checklist that I talked about earlier might be handy. You'll need to be alert to nuances when monitoring the administrative expense limit, the duration limits, and staying within the authorized expenditures that the TIF plan specifies, so you can recognize when to take appropriate action. It's also very important to track in-district and out-district increments and expenditures. As Jason discussed earlier, pooling limits apply to expenditures outside of the district but within the project area. This is a common area of non-compliance and misunderstanding. So an authority is well advised to keep its own spreadsheets that explicitly distinguish between balances of poolable increments and balances that are required to be spent in district. Make sure you have a firm understanding of the 5-year rules provisions regarding what is considered in or out district. Pay attention to how the 6-year rules extra annual limitation and early decertification requirements may apply. And finally, make sure to monitor overall limitations. Usually that's 20% for districts other than the redevelopment districts, which have a 25% limit. And there may have been an election to pool an extra 10% for housing if that's in your TIF plan. A few more activities not to overlook include the fact that you must return or use appropriately any tax increments by September 30th of each year. And you must send the county evidence of parcel activity by February 1st on the 5th year after certification in accordance with the 4-year rule, which Jason talked about earlier. In addition, make sure to respond to any inquiries from the OSA to resolve potential questions and concerns in a timely manner. All of this is to say it's a good practice to routinely monitor your TIF plans and your agreements. Doing so will help you stay within limitations and identify necessary or possible modifications in a timely manner. You should also review the terms of pay-as-you-go agreements on a regular basis to help avoid overpayments after the term of the agreement ends. We've actually seen some violations in the past couple of years involving overpayments, and it can be a really big mess, to clean those up. So keeping on top of agreements will also help you to identify any possible defaults that should cause payments to cease, or perhaps to consider any prepayment opportunities that you might have. Likewise, monitoring bond payment schedules and the terms of interfund loans to help ensure their payments are proceeding as anticipated. In particular, it's important to ensure interfund loaned interest rate limits are identified and that the interest is applied accordingly. We have seen, like in a few instances, that interfund loans are treated as secondary to other obligations, and it seems some authorities are a little slow to make payments when appropriate. So just make sure that you're doing a regular review and keeping on top of that. Next, we're going to talk about reporting requirements to the OSA. Many OSA forms can be found in the state auditor's form entry system, which most of us refer to as SAFES. For TIF, this includes the TIF plan collection form for new and modified districts, the annual reporting form, and the pooled debt form. We will also be talking about the certification request supplement and the confirmation of decertified TIF district forms a little bit later, and those are on our website, but they're not in SAFES. Authority staff can request access to SAFES by emailing or TIF email with your contact information. If a third-party representative, such as a consultant or anyone not employed by the authority, must complete the SAFES authorization form, and their access will be terminated at the end of the calendar year or earlier by request. So this is a screenshot of the login page for SAFES. And if you need help with this, you can see that there is a training video, some FAQs, contact information, and you can also find the link to the user authorization form that I mentioned. And again, we're not going to go into great detail about the TIF plan requirements because we are making that video about that topic, but I just wanted to point out the general procedures for filing a new plan with our office. So according to statute, TIF plans must be submitted to the OSA within 60 days after the latest of the following activities. The filing of the request for certification of the TIF district, which I'm going to say 99% of the cases this is going to be the latest date, but it could also be after the approval of the plan by the municipality or the adoption of the plan by the authority. So again, you technically have 60 days after the certification, the request to certify, to file with our office, but as far as we're concerned, the sooner you can send that plan in, the better, even if you haven't requested certification yet, because it helps us establish a record in our database, and we can even be helpful sometimes and catch technical errors and missing information, which will help you avoid issues that contribute to confusion or even non-compliance later on. We also need a TIF plan collection form for modifications for any change to a TIF district, and that could be a simple administrative change, or if you have a more formal modification that's gone through the full approval process. And next, we're going to take a look at where to download the form and how to submit it. So this is a screenshot of the Forms tab once you're logged into SAFES. In order to file a new plan, you'll go into SAFES and go to the Forms tab, and then make sure you're in the TIF subtab and the current year. Then press Download Form next to the TIF Plan Collection Form New District under the Authority header. If it's a modification for an existing district, find the related district and download the TIF plan collection for modified district. And this is also where you're going to download your annual reporting form, which we'll talk about in a minute. But before we talk about that, on the subject of TIF plans, after you've completed your form, you're going to submit it under the Submit Documents tab, which is up on the screen here. When you upload the plan form, do so in the original Excel format, and you'll also be asked to provide an attachment, at which point you'll want to attach the TIF plan as a PDF. For a modification, sometimes a resolution or other documentation might be adequate. But in either case, if you have multiple documents that you need to add, you'll need to amalgamate them into one file. And if you don't have Adobe Pro or you don't know how to do that, just email us and we'll be happy to assist. Right, as you might be familiar with and might be in the middle of right now, a critical component of maintaining compliance with the TIF Act is to report activities to the OSA on an annual basis. And before we get started, I just kind of wanted to get a sense of where you are all at in this process. So let's launch the next poll question. Have you submitted your authority's TIF annual reporting form for 2021? Or did your consultants do it? Yeah, about a third of you have already done it, which is actually reflective of what my report status did this morning. So kudos to you if you're on top of it. And if you're still working on it, that's fine too. There's still another week and a half to go before the deadline. And hopefully this section will help get you oriented. Okay. So annual reporting form. They are downloadable from SAFES, and they are typically released in early May. And you'll find them in the same spot that I showed you when we were talking about the modifications and the new TIF plan forms. They are due August 1st for the year for each year for activities occurring in the previous year. So for example, the current report form available in 2022 is for activities that happen in calendar year 2021. The reporting requirement begins when the district's original net tax capacity is certified by the county auditor, and the report will be due the following August 1st. So for example, if the district was certified in 2022, the first annual report will be due by August 1st, 2023. Authorities must continue to file annual reports until the district is decertified and all tax revenue has been expended or returned to the county auditor. So as Jason noted, it is common for tax increments and assets to remain on the balance sheet and for reporting to continue. Generally, we like to see that no assets remain on the balance sheet before we determine that reporting is no longer required. Accurate reporting allows authority staff, advisors, and the OSA to spot and promptly address potential troubles and to help avoid larger problems that span multiple years. We have several different resources to help you complete the annual form, including the report form instruction document. And we highly recommend you refer to this document if you need explanation of a particular line, as it's pretty detailed. We also have a video series about the form to walk you through each line and provide examples. And additionally, we often post some hints and tricks in the state auditor e-updates around this time of year. And we've published several articles and statements of position that may be relevant. And of course, you can always email us or call us if you have any questions. We're happy to help you navigate any issues that you might be having. All right. So in case you're not acquainted, I just wanted to show you quick what the form looks like. It's an Excel document, and there are 13 tabs, and you'll need to check and complete each one of them. Some of them might be really fast and just a matter of saying no and moving on to the next tab, but some of them might need more attention depending on what kind of funding your district is using. And this year we added a new section to the form at the bottom of the transfer tab. This section is meant to be used by authorities that are taking advantage of the temporary transfer authority that Jason was talking about at the beginning, the legislative update. So this may not apply to you, but in which case you can just answer no and skip the section. But I just wanted to show it to you in case you've done reporting before and didn't recognize this new table. If it does apply to you, hopefully it's pretty intuitive or the instruction document is helpful. But if it's not, please feel free to reach out to us. We're just going to talk about a few tips to help you avoid errors when working on the annual report. The first is to always verify any pre-filled information in the form. The district info tab is basically a window into the information that we have in our database at the OSA about the facts of the district. But we do collect data from various sources, so you definitely want to make sure that it's all accurate. We actually just had a situation yesterday where an authority realized that their ONTC was like vastly different from what they were expecting. And, you know, again, we get some of this information from external sources. So always take a look and make sure they make sense. There's also many pre-filled numbers throughout the document, and a lot of them are from your district's past reports. So especially if you're new and have inherited these records, you'll want to understand them and verify that they match your internal records. It's a pain to fix problems, but it's always better to catch them sooner rather than 5 years down the line when they've compounded into a major problem. When completing the form, we understand that it's really tempting, but you cannot copy and paste information, unfortunately. Doing so can overwrite formulas in the tables and lead to importing issues on the back end. So if you've done that, we might have to send it back to you to recreate, and nobody wants to do that. So please don't copy and paste. One of the biggest tips I can give you is to check the Home tab of the form. If you scroll down a bit and look at the table listing read messages, that, you know, there's a little picture of it on the screen here. If there are any numbers in that table, it indicates that there's logic issues or missing information that need to be corrected within the form, and it tells you which tab they can be found on. When you go to the tab, you'll find more specific information in the right-hand column of the affected cell. You might need to scroll over to see them on certain tabs. And finally, don't underestimate the importance of the Comments tab on the form for any anomalous circumstances or to help us correct any pre-filled information that you can't change, or anything else you'd like us administrators or the auditors to know about the form. And once again, email us if you have any questions at all. Okay, so moving on from the annual form, but on a related note, authorities are required to send a copy of the annual disclosure to the county auditor by August 1st, and it must be published in a newspaper of general circulation by August 15th. The information required for the annual disclosure appears in the ADS tab of the annual reporting form, which is kind of there to help you out. And it must be published even if all the amounts are zero, and especially make sure that you verify all of this information because some of it is imported in. All right, this is a sample of a published annual disclosure statement where you can see how the authority with multiple districts identified them in columns. Don't forget to include all of the contact information. And if you're in a fiscal disparities area, the line for increased property taxes and footnotes need to be included as well. The pooled debt forms, if you have any, are similar to the annual report forms in that they're submitted through SAFES and they are also due by August 1st. Debt form is required for any TIF bond or other financial obligation excluding non-TIF bonds to which tax increment from 2 or more TIF districts have been pledged to pay the debt or used to pay the debt or received proceeds from the bond. This last condition applies even though only one district is pledged in making payments so that the proceeds of the bond can be tracked to ensure they're only spent on TIF qualified expenditures. And if any of that's confusing to you and you're not sure if you need this form or not, there's instructions on our website that will help clear it up. And speaking of, this is a screenshot of our forms page. And again, this link is available in our handout. Here you will find instructions and samples of all of our forms, including the annual reporting and the pool debt form. And this is also where you can find the next two forms that we're going to talk about. So the first here is the certification request supplement, which is meant to accompany a request for certification when you make that request to your county auditor. This form is not a requirement, and several counties may have their own prescribed form for requesting the certification of a document. So if they do, definitely use that instead. But if they don't, you might want to use this supplement. And just for background, in the past, the certification requests have generally been letters accompanied by the Department of Revenue's certification request supplement, which had been around forever. But Revenue has discontinued offering or updating that supplement. So in 2020, the OSA created a new, better if we say so ourselves, version of the form. It contains a few questions to help highlight key pieces of information about the district and should make finding the information that counties need a little easier. And it may assist in your record keeping as well. And finally, we have the confirmation of the certified district form, which everyone calls the decertification form. And that must be sent to the OSA as soon as possible after decertification. The purpose of the form is to ensure that the authority, county, and OSA are all on the same page. The idea is that the authority fills out Part A of the form, providing information about the district, the decertification date, final distribution, and any amounts the authority is ready to return. Then they'll send it to the county, who completes Part B, confirming that information. As a note, please don't leave any lines blank, particularly those that are numbered in the middle, as that is the information that we are looking for and that we're asking the auditor to verify. So if the answer is $0, please write that, or if you don't know, then just make sure to call that to the attention of the county auditor reviewing the file. They'll probably know. And by the way, the authority, not the county, is ultimately responsible for making sure a completed copy gets into our hands. But a lot of counties do copy us, in which case you're good. But if they didn't, make sure that you forward that to us as well when you get it back. Completed forms, meaning signatures on Part A and B, should be emailed to our TIF email. You don't need to mail a hard copy. Unfortunately, this is currently a paper passed or scanned in email process, but we're working to streamline it and get it to a more efficient electronic process, which hopefully will be coming soon, but we don't have an estimate at this point when we'll have that. For early decertifications, in addition to the decertification form, please provide a copy of the resolution that was used to decertify the district. A county must decertify a district upon reaching the statutory limit, so we'll still need the form, but a resolution isn't necessary in that case. And that kind of wraps up the forms section of this presentation, and we're almost done. Were there any questions? If not, I will then turn control back to Jason for some final thoughts.
We did have a question. Someone is asking, is there a process to request an extension to the filing deadline?
Okay, and this is in reference to the annual reporting form, I assume. So
Yes.
all those deadlines are statutorily required, and we don't have the authority to grant extensions or change it or anything. But what I will say is, you should get your forms in as soon as humanly possible, but we won't send a formal notice that you're delinquent until third Tuesday in August. So that's August 16th this year. And yeah, so, don't lose any sleep over it. If we don't get the form by October 1st, then increment's going to be we're going to contact the county auditor and ask them to withhold increment until we get the forms. So, you know, it's not great to be late on your form submission, but there are ways to rectify it. So, all right, anything else?
I don't see any other questions at this point.
All right, well, I'm going to turn it back over to Jason then.
All right, thank you, Haley. I just wanted to end here with a couple of final thoughts. So in order to be effective in monitoring and reviewing TIF activity, it's important to stay informed of TIF laws, requirements, and developments. Authorities can stay informed by following our office's information, which includes, we do weekly e-update items. We email them out every Friday, and they also get posted on our website. We have TIF articles on our website that you can check out. We have statements of position, various training videos, and then we do these annual webinar sessions. Authorities or your advisors should stay abreast of changes to the TIF Act and even broader property tax system changes that might affect TIF, or changes to the Internal Revenue Code that might impact any TIF tax increment activity. And in particular, keep a lookout next year for the changes that we tried to get through this year, but we'll see if we can get to them next year. So, and lastly, I'd suggest that a helpful mindset for making effective use of TIF is to understand that TIF districts are capturing valuable tax base, and thus it's wise to seek to achieve early decertification and make that tax base available as soon as possible. It should also be noted that returning unneeded increment has a lot of merits and should be thought of, and it shouldn't be thought of as like giving it up or returning it back to the state. We've sometimes encountered municipalities delaying decertification and holding on to surplus increments and wanting to keep the increment stream going for more expenditures. But consider that the authority will get its share of returned increments sent back, and those distributions are free of TIF restrictions and available for any lawful purposes. We've sometimes heard of cities referring to not wanting to give it back to the state, but this is kind of misinformed because it's really going back to the county, the city, and the school district in proportion to your tax rates. So all that gets returned to the affected taxing jurisdictions. And then second, trying to keep tax increment streams going means that the tax-based benefits are being delayed as long as that district remains active. And lastly, tax increments are essentially attributable to county, school, and other taxing district tax rates and bases. So they're not just revenues appearing in a vacuum. The tax-based benefits of early decertification will also be appreciated by the other taxing jurisdictions that your taxpayers are also paying taxes to. So those are just kind of general perspectives that can, for the most part, help you steer clear of potential problems and ensure the successful use of TIF. And that concludes this training. Thanks for joining us. And thank you for participating today. We appreciate it. And feel free to contact us with any questions or suggestions for additional training. And have a great day.